Welcome to today's presentation, ladies and gentlemen. Today we'll be looking at financing of small business projects, and our focus will be on short-term debt financing. I'm your presenter, Tutor Maston. Finance is the basis of development of any business. It is the main component of every business. So, among all the resources like labor, finance, and so on, finance is the basic or is the main resource that is required. Owners of most businesses do not have enough to contribute to the business. As such, borrowing will be required, because if you don't borrow and you don't have enough money, then how does the business run? So you need to borrow. But to do this, you need to find the most appropriate type of financing, the most appropriate type of borrowing. And in this case, for small startup businesses, the most appropriate kind of financing is actually short-term financing. There are three types of financing, and these are short-term finance, medium-term finance, and long-term finance. But this presentation will focus on short-term finance, which we are saying is the most appropriate kind of financing for small businesses. Follow me on Tutor Maston YouTube channel. Click the subscribe button at the right bottom corner of the screen to receive notifications on new videos. Short-term debt financing. A short-term loan is a kind of loan that needs to be repaid in not more than a year, in less than a year. So it can be 2 weeks, 5 weeks, 3 months, up to 1 year. So that's how long a short-term loan has to be repaid. And this short-term loan, usually there's no collateral attached, because the period is short. And also, if any collateral should be attached, it should be just it's just a small amount. It's just a small amount of collateral or no collateral, because the period and even the amount involved is also usually not very big. So below are the most common types of short-term loans. The first one is the overdraft finance. An overdraft is a kind of facility that is usually given to current account holders. So a company usually runs on a current account. It gets into agreement with the bank to authorize the company to withdraw more than they have in the account. If you have 6,000, but you need a 10,000 on that particular day, you may be allowed to withdraw 10,000 from the account despite having only 6,000 on the account, meaning you have overdrawn your account by 4,000, which is the deficit of what your account balance is. Now, this is the cheapest form of short-term finance which can be provided by any commercial bank. The overdraft is specifically designed to allow the business to cope with seasonal cash flow fluctuations. You know, there are fluctuations. You don't get the same amount of money on the business every month. Sometimes you have more money. You find this month, the other month you have less, or even just on days, particular days. Today you have more business, tomorrow the business is low. So there's some fluctuations in the amount of money that you have in your account. So the overdraft stabilizes the kind of money that you need on a daily basis, because when you have what is enough, you get what is enough from your account. When you have less, you will get the difference from the overdraft. So this overdraft, it also assists in the funding of capital. It will help with the working capital requirements. So that is the overdraft facility. And now we look at the trade credit. Trade credit is an arrangement between two companies, a company to company kind of business, or we can call it a B2B or business to business kind of agreement. So in this kind of business or agreement, a company, which is a customer, purchases goods. It purchases goods without paying for them in upfront, but they make an arrangement to pay at a later scheduled date. So it doesn't pay there and then. It will pay maybe after a week or after 2 or after a month at the end of the agreed period. That's when they'll pay, but they'll get the goods in advance, start selling, do with them whatever they can do. They are theirs, but the payment will come at a later stage. So that is a trade credit. Always bear in mind, it's a business to business, no individuals, company to company. And the next one is a bridge loan. A bridge loan is kind of a relief loan. Bridge loan or bridging loans, it's kind of a relief loan. How? Usually, a person would want to get a very big amount or a big amount of a loan from a bank or any other institution that is a lending institution. Now, it may take some time to process this loan or to authorize this loan. It may be big, and also it may be for a long term, for a long period. So because for this loan to be processed to take long, one may opt to get a bridge loan, which is now a loan that one can start using at the moment while waiting for a bigger loan or for a long-term loan to be granted. So it works as a relief for that period. If you are getting a loan today, you apply for a loan today, and they tell you this loan will be granted after 3 months, and then things you want to work for will not wait for 3 months. You need to start working now. So it means now you get a bridge loan on which that money you'll be using from today up to the end of the 30 days before you get a bigger amount. So it works as a relief during that period, so that when you now get that bigger amount, from that amount you're now going to pay back the bridge loan, and you remain with the money that will now be paid back in a long term, which is usually a big amount. Okay. Now, fourth, we'll look at demand loans. Demand loans, as the name entails, it is a demand loan. It is paid on demand, meaning a lender can just can give you notice to pay back within a short period of time. Maybe the arrangement could be for 3 months, but you find that before 3 months, maybe just within the first 1 month, the lender tells you that you need to pay back the loan. They need it back. So maybe they'll just give you maybe 3 or 4 days notice to pay back the loan. So you have to pay back within that first month, which they've asked for the loan to be paid, despite the loan being for 3 months. And it also works vice versa. The borrower can also just decide to pay back. You pay. You have agreed for 3 months, but just after 1 month, you know you have money to pay back the loan. You just go and you pay. And there are no early repayment charges, because the loan itself, the conditions or the terms entail that you can pay back on demand. Okay, so that is the demand loans. The next is the personal loans. Also, this one, as the name suggests, these are personal. They are for individuals. They are for individuals. So this kind of loan, it is a kind of loan where, as an individual, when you get it, you can use it in any way that you want. There are no strings attached to how you are going to use that money. You can buy a car if you want. You can buy a house. You can invest. So whatever way you want to use it, you can use it. There are no strings attached, and no one will question you to say, how did you use the money that you got? It's very different, like say from a mortgage. A mortgage, it is specifically for a house. You do something else, you are in trouble. But with personal loan, you are at liberty to use it in any way that you want. And lastly, we'll look at factoring. Factoring is an arrangement by a company. It's an arrangement where a company purchases the trade debt due to another company at a discount. So a company will purchase the trade debt for another company at a discount. What do we mean? What we mean is that a company may be owed, for example, 100,000 by another company. Now, because this company needs some agent funds, it will go to another company, which we call now a factoring company, which buys the debt from others. So it will buy this debt from this person by paying them less the amount of the debt. So they will pay maybe 90,000 instead of 100,000. They will pay 90,000 according to the agreement that they will make. Then when that debt is due by the company that borrowed or by an individual that borrowed, them they will claim the 100,000 from that person or from that business. So they'll make a profit of 10,000 kwacha. So that's how factoring works. So one advantage of factoring is that it relieves a business of the debt collection hassles. There's a lot of things involved in debt collection, especially when one is having problems collecting that debt. So those hassles, those complications involved in running up and down, trying to collect that debt from that person. When you sell that debt, you are relieved from all those running up and downs. So they are transferred to the company that has purchased the debt. It is because of these difficulties in collecting debts that also a factoring company factors in those problems. So when they are buying the debt from another company, they won't just look at a small amount of profit. They also look at what hassles are they going through. What if that debt is a bad debt? Means they will end up being in a loss. So the amount they are going to pay according to the agreement that they will make, they will ensure that the amount they are going to buy that debt from is also at a small price. So that in case they also lose out on it, or maybe that person doesn't pay those debts. So it will depend on how risky that debt they are buying is. If it's a high risk, then they'll buy it at a lower price. If it's low risk, then they'll buy it at the higher price. But the discount will still be there. There'll still be room for the profit. So that is factoring. So these are some of the short-term debt financing that is there. The overdraft finance, trade credit, bridge loans, demand loans, personal loans, and the factoring. And now the other thing, when we talk about factoring, we are talking about the domestic debt. So this is domestic debt. Companies within the same country. But now there are also some debts that are sold and bought from one company to another, from companies in different countries. So you go international. From one country, you jump to another country, buy a debt from there. So when companies are in different countries, instead of factoring, this thing is now called forfeiting. So forfeiting and factoring are the same, but except the companies where they are situated will determine whether this is called factoring or it's called forfeiting. So within the same country, it is factoring, but companies from different countries, it is called forfeiting. This marks the end of today's presentation. In my next presentation, I'm going to look at the advantages and disadvantages of overdrafts. Follow me on Twitter, Maston YouTube channel. Click the subscribe button at the right bottom corner of your screen to receive notifications on new videos.